Hi there. So welcome to lesson 2 on risk management. So in the first lesson we discussed the various issues that you need to understand about risks, especially our transaction risks. I explained to you how the currencies are read, or how when the exchange rates are quoted, how they are read, the buy and then the sell both from the perspective of the customer or the client, and also from the perspective of the forest or the bank. So you saw how we solved the various questions in relation to what to do when we are buying, what to do when we are selling, and we ended up saying that the second currency, which people think usually, or others think usually, that it is the currency of the home country, it is not always going to be the same. So you just have to note that the rate given is just going to be read in relation to the way the currency that has been given. So the home country currency can be first, it can be second, but it is not about where it is positioned, it's about how you read the exchange rate. And we concluded on treasury risk management, or transaction risk management, and we said that the only way we can measure the risks, with the final question we saw that in the first example we were making profit, in the second example our profit had reduced drastically, but in the third example, that is the II, we realized that we were making huge losses. And so we mentioned that how then do we protect ourselves against the negative movement in the exchange rate? Because remember, there could be a positive movement in the exchange rates, but then we are not interested in the positive movement. Yeah, if it is a positive movement, it is good, but we are finding out how we can speculate as CFOs, helping the businesses in order to hedge themselves against negative movement in the foreign currency risks, especially if you're in a country like Ghana, where the Ghana cedi with other foreign currencies keep depreciating, or the Ghana cedis keep depreciating against foreign currencies. And so almost always the duty of the CFO and the businesses will be finding out the ways and means to reduce the effects that the depreciation will have on our finances and on our operation. So what we want to look out for here is the various ways, the various methods, the various techniques that can be used by businesses in order to hedge against foreign currency risks. Now, I'm going to do this in such a way that you'll be able to understand, and you must understand that when it comes to advanced financial management, everything we're going to be doing here, the examiner is going to be, it's likely to ask you depending on wherever he wants to come from. But in financial management in level 2, it's going to be limited as to what the examiner will ask you. So be ready and be open-minded to know the distinction, especially if you are doing financial management in level 2. So when it comes to transaction risk management techniques, we have I've divided it into two. We have what we call the internal hedging techniques, and then the external hedging techniques, and also external hedging techniques. So we're going to discuss these and then also help us to know the various calculations that has to be done, the various methods that has to be gone through. Now, if the first lesson was really impactful and you really understood it, make sure you stay with me clearly on this one also, because yes, it may look technical, but it's not technical. It has a principle. When you follow the principle, you follow the process, then you will be able to understand it and you will be able to solve any question at all. So let's begin with the internal hedging techniques. Now, what are these techniques? Basically, these are the techniques that the company can employ within to manage transaction risks without any involvement of external parties. So with the internal hedging techniques, the company's own decision, the company's own policies, they put in place so that it prevents the company from being exposed to negative movement in the exchange rate. So these internal techniques are four, and we are going to be discussing them. So they include currency of invoice, or what we call invoicing in home currency, matching receipts and payments, netting, that is bilateral or multilateral, and then leading and lagging. So these are the four internal techniques. You realize that with these techniques, what happens is that the company does not relate with any third party to make it possible for them to prevent against negative movement in the exchange rate. Rather, it is the company's decision they make. Now, if we are doing financial management, these techniques, when it comes to these techniques, you need to only know about their theories. That's it. You're not required to know about the calculations about these techniques. But then if you are doing advanced financial management, then the calculation about the netting is very critical, and you have to know and understand it in relation to that. So let's get into it and see what we do. So the first one is invoicing in home country currency. Now listen to the name. Invoicing in home country currency. So it involves invoicing in the company's home country currency rather than other currencies. So that is what it means, right? So when we sell goods and we realize that we want to prevent ourselves against exchange rates, we don't charge the company, our customers in any standardized currency. Rather, we charge them in our currency, in our home country currency. So for instance, you go and buy goods from a company in the US. They won't charge you in Ghana cedis, they will charge you in dollars. It is invoicing in their home country currency, so that if there is any movement in the currency, it won't affect them. They will still receive what? That's money. That is what we mean by invoicing in home country currency. The advantage of this is that the company can avoid exchange rate problems. This is because the risk is passed on to third parties. All right, so we pass on the risk to the person who is going to go look for the money to pay us, because at the end of the day, we would want our money in our currency and they will give it to us. So they would have to suffer with the exchange rate. So you see, this is a policy. This is a decision that a company makes, that for everything we sell, in order to prevent ourselves against negative movement in the exchange rate, we issued our invoice, or we issue our invoice in our currency. So at any point in time, we will receive that money in our currency, and we wouldn't have to ask, do we sell or do we buy? That is the thing about that. A demerit of this is that this is less competitive, hence difficult to make more sales. It's difficult to make more sales in relation to this, because the customer, the people to whom we are selling, also know that if you are invoicing in your home country currency, then they are exposed to negative movement in the exchange rate. So sometimes they may not be willing to buy from us. So that is a demerit of it. But that is the first method that we can talk about: home currency, or invoicing in home country currency. Number two, matching receipts and payments. Matching receipts and payments. This involves netting of the amounts to be received against the amounts to be paid. Now, so what does this mean? Now, with this idea, or with this technique, what happens is that, for instance, we sell to a company outside, and we buy from another company outside. So matching receipt against payment, for instance, will mean that we will have a foreign bank account in the country that we buy from and sell to, so that when we sell goods to the company in that country, they will pay the money into our accounts, so that when we are buying, we will pay the money from our accounts. In other words, we are matching the receipts in the foreign currency against payment in the foreign currency. So technically, we are reducing the effect of how much exposition that we will, or how much we will be exposed to in relation to the foreign exchange rate movement. So that is the issue about matching receipts against payment. So the foreign currency under consideration, how much are we receiving of it, how much are we paying? So if we are receiving less than how much we have to pay, what we are receiving, we will use part of it to pay for what we have to pay. Then what will be left to be paid, then we will find out how we will pay. So technically, this helps us to reduce our risks. An advantage of this is that there is no need to exchange funds if the payment and receipt exactly set off. Yes, because there is no need for any exchange of funds, because if it's set off, we just issue the payment and we don't have to go and exchange any foreign currency any longer. But it also has a demerit, okay? Ideally, it requires equal and opposite transaction in the same currency, which is unusual. For instance, you buy goods from someone in the UK, meaning that you're going to pay the person in pounds or in euros, meaning you should be able to receive some money, or you should be able to get a company from the European Union or from UK to buy from you so that you can have the pounds. So even though it is realistic, it is sometimes difficult to, it's unusual. I wouldn't say it's difficult, but it's unusual for this particular thing to happen. So the first one is invoicing in the home country currency, and the second one is matching receipts against payments. The third one is netting. Now you remember one of the risks we spoke about earlier is the issue in relation to translation risk, and we said that the home country or the parent company at the end of the accounting year would have to translate the results of the subsidiary companies in foreign currencies into the home country currency, and we said that the risk that there will be a reduction in the money as a result of the translation is what we refer to as what? Translation risks. Now, netting off as a third technique has to do with where, for instance, there are subsidiaries, the same idea. So we are a parent company and we have subsidiaries, and they buy from each other, something like that. So netting off has to do with where maybe this person owns that person, the parent owns a subsidiary. So what we do is that we net off, and so that at the end of the day we find out how much is owed to and how much is owed by. Another illustration of that is just like matching the receipts against payments. So you buy from me, I also buy from you. So what we're going to do is that since you buy from me, I owe you, right? Since you buy from me, it means you owe me, and when I buy from you, I owe you. So netting off simply means how much do I owe you, how much do you owe me. So let's offset it. Then let's find out the difference as to who is going to make an additional payment. Now, when we are using these techniques, what happens is that we net off intercompany balances before arranging the payment. We net off intercompany balances and before arranging payments. Bilateral netting off involves two groups of company, whilst multilateral netting off involves several groups of companies. So let's look at a question about netting off. Now remember, you will not be required to do any calculation on this if you are doing financial management. But if you are doing advanced financial management, certainly the examiner could ask you a question about this. So let's look at a question about netting off and see how we can go about it. And remember, this is where we go through a step, we go through a procedure, and you should be able to follow through with the procedure and with a step so that you will be able to understand well what we are doing. So let's look at it. A group of trading companies controlled by the USA has subsidiaries in the UK, South Africa, and France. All right, so let's get a picture up straight. So there is a company in the US, so the parent company, and the parent company has three subsidiaries, right? One in the UK, one in South Africa, and the other in France. So three countries, and the parent company is in the US. Then we are told that as of 31st December, the intercompany balances were as follows. So we've been given the intercompany balances, and we've been given receivable and payables. So we have receivables and payables, and under the receivables, we have UK, France, South Africa. Under the payable, we have South Africa, France, South Africa, UK, and France. Now, so what does this mean? This means that as the South Africa company owes, so the South African company owes the UK company an amount of 120,000. 1.2 million, sorry. Then the France company owes the UK company an amount of 480,000. Then the France company, I need to get that right. So the France company owes the South Africa company. No, this is wrong. The UK company owes, yeah, the France owes the UK company. This is correct. The South Africa company owes the France company $800,000. And then I know you have the question, but I'm just trying to put the preambles down so that we know what we're doing. The UK company also owes the South Africa company $740,000. And finally, the France company owes the South Africa company with $375,000. So this is what is happening here. These are payables, these are receivables. So these guys owe these guys, right? Then we are told that currency-wise, the UK company's currency, certainly it's going to be in, so South Africa is the SA rank, right? The UK is the pound, okay? And then the France is the euros. Okay, so these are the currencies dominated. Then we are given the following exchange rates to translate the balances. One, we are told that a rand 6.125 is to $1. We are also told that 0.680 pound is $1. And then we've given euros, and we are told 5.880 euros equals $1. So this is the information that we have by the question. A company in the US, the parent company, in dollars certainly, and it has 3 subsidiaries in the UK, in South Africa, in France. Currency dominated, the UK company is in pounds, South Africa is in the South Africa rank, and then the France company is using the euros. Then we are told that the South Africa company owes the UK company, meaning these are payables and these are receivables. So if you look at it closely, you realize that the South Africa company owes the UK company 1.2 million, and they owe their 1.2 million rand. Okay, they own their 1.2 million rand. Then the France company also owes the UK company. The South Africa company owes the France company. Then the UK company also owes the South Africa company. So look at it. The South Africa company owes the UK company some amount of money. The UK company also owes the South Africa company some money. Then the France company also owns the South Africa company, and the South Africa company also owns the France company, and then the France company owes the UK company. So you realize that this is an intergroup, all right, intercompany balances. So they owe each other. Now we have to translate the figure, we have to translate these balances into the account of the parent company, which is in dollars. And so that is why the examiner has given us the exchange rates dominated in the parent company's currency, the dollar. So a dollar is 6.125 rank, and then a dollar is 0.680 pound, and then a dollar is 5.880 euros. So this is the question that the examiner has given us, and this is how the question is going to be structured. Now the people who are paying will have their currency. So this figure here is 1.2 million rank. This figure here is 480,000 euros. This figure here is 800,000 rank. This figure here is 740 pounds, and then this figure here is 375,000 euros. So that is what you need to understand about this. Required. Calculate the net payment balances of the subsidiaries after netting off the intercompany balances. So the examiner wants us to calculate the net payments between. So at the end of the day, you owe me, I owe you. So SA owes the UK owes the SA. So when we balance off, how much will be left? The FR company owes the SA company, and then the SA company also owes the FR company. When we balance it off, how much will be left? That is what we want to do here. Now, there is a methodology we need to follow when we are solving netting of questions. There is a methodology we have to follow when we are solving all these questions. And there are 5 or 6 things that we need to go through. I'm going to read the methods or the procedure to you, then we take them one after the other and solve the main question. So 1, convert outstanding balances to a single currency using the exchange rate for the treasury function or parent company and the respective subsidiaries. So the first step is, this is in rank, this is in euros, this is in rank, this is in rank, euros, and this is in what? Pounds. So at the end of the day, we need to convert all of these foreign currencies into a single currency. That is the currency of the home country. So the dollar. So we will convert all of this money in euros, in pounds, and in the South African rand into a dollar. That is the first step we go through. Second, set up transaction matrix. So we're going to set up a transaction matrix, and the transaction matrix will help us to do step 3, which is transfer converted balances to the transaction matrix. So we're going to put a table down and see owed by, owed to, and then we put in the figures there in relation to that. Step 4, total columns owed by and the rows owed to. So we're going to have columns and we're going to have rows, all right? And the columns will be owed by, the rows will be owed to, and at the end of the day, we're going to add the totals. From there, we net off balances owed to, and then owed by, and then the sixth thing is that we conclude on the net balances. Let me take that step again, then we go through the solution. So 1, convert outstanding balances to a single currency using the exchange rate for the treasury function or parent company and the respective subsidiaries. Then we set up a transaction matrix. Then we transfer converted balances to the transaction matrix, total the columns owed by and the rows owed to, net off balances owed to and owed by, conclude on the net balances. So this is what we're going to do in relation to that. So let's begin the journey on how we can solve this question. So we already have this down. We know that they owe them this way, and these are the exchange rates that we have here. So I'm going to soup this up and put down my table to help us to convert the currencies in relation to that. One notice, you can see that the currency here is just 1. So we are not going to be thinking about are we buying, are we selling. It's just 1. So it's straight up for us. And we go there. So step 1, we convert, right? We convert into single currency. And that is what? In the dollar. So when we are converting into single currency and it's the dollar, we're going to go with this. So we put here receive and put into bracket owed to. Okay. Then we put here payment. That is owed by. Then we put the conversion here. And we put the amount in dollars. So this is the table that we put across in solving our question. Then we put the countries down. So let me sort of divide them like this. 1, 2, 3, 4, then 5. So the UK will receive some amount to be paid to the South Africa company. The UK company will receive an amount that will be paid by the France company. The France company will receive an amount to be paid by the South Africa company. And then the South Africa company will receive an amount that will be paid by the UK company. And then the South Africa company will receive an amount that will be paid by the France company. So this is the setup. So these are receivable, these are the payables, right? Now let's look at the conversion. Now, if we look at from the question and what I illustrated, the South Africa company will pay the UK company an amount of 1.2 million rand. Now, if you remember the exchange rate that I was given, the rank was 6.125. So $1 was 6.126. Is it 126? Yes, $6.126. So how many dollars will 1.2 million ranks be? So we're going to do what? Be dividing throughout. So we're going to have 1.2 million divided by 6 point, or 1 point rather, 6.126. So when we divide and punch that out, we go to 195, sorry, $886. So $195,866, meaning that 1.2 rank is 195,886 US dollars. Then we go to the UK company. Now the France company owes the UK company an amount of 480,000 euros. So we convert the 480,000 euros into dollars, and the exchange rate is 5.880. When we divide up, we will get 81,663 US dollars. Third, the South Africa company owes the France company an amount of 800,000 rank. So we divide that by the rank, which is 6.126, and that should give us $130,000, 591. I hope you are following the idea. The UK company owes the South Africa company an amount of 740,000 pounds, and the exchange rate for the pound is 0.680. So when we divide, that will give us $108,824. $108,824. And then finally, the France company owes the South Africa company 375,000 euros, and that is going to give us 5.880. When we divide, it will give us $63,776. So this is the first step. Convert outstanding balances to a single currency. That's the first step. Now you got to be careful here. The idea is based on the payments, all right? The payments. So these people are owing these people 1.2 million rank, right? So we convert. These people are owing these people 480,000 euros. These people are owing these people 800,000 rank. These people are owing these people 740,000 pounds. And these people are owing these people 375,000 euros. So that is the first step. That is the first step we go through in solving our question. So once we have, this is now going to be our focus. This is the figure we're going to be using from step 2 to step 6. At the end of the day, we are now going to be working on a single currency. Okay, we're not going to be meaning that these people will pay these people this. So while this person is paying this person is receiving. So if you check, let me just give you an example to see what we are to understand what we are doing. So look at this and this. You will see that the South Africa company will pay the UK company $195,886. The UK company will also pay the South Africa company $108,824. So when we say netting of, meaning the South Africa company will say, I owe you this, you owe me this. So let's net off. And then we find a difference. That is what we are talking about here. And that is what we're going to be doing from the second step down to the sixth step for us to finish. So after we do that, we say that we set up a matrix so that we can do our workings in relation to that. So let's set up our matrix then. Now, with the metrics I'm about to set up, we're actually going to use it to solve step 2, step 3, and then step 4. So, we're doing step 2, step 3, and step 4 right in the metrics I'm about setting up. So we will put here owed to, then we will put here owed by. And you know that we have 3 countries. So we have UK, and South Africa, and we have France. And we're going to put a total owed to there. Then we're going to have owed, going to have the same thing here, UK. Let me bring it down a little bit. UK, South Africa, and France. So let's kind of divide it up and have fair idea of what's happening here. Right. So owed by, owed to. My division is 4. My division is 4. Let me do that again. Let me bring this down. So UK, South Africa, and then France. So if we go back to our metrics, we realize that now certainly the UK company cannot owe itself, right? The South Africa company cannot owe itself. The France company can also not owe itself. So that is out, right? That's the first step, it's out. So those midpoint areas will be out. Then if we go back to our question, we saw that the South Africa company owes 195,886. So 195,886. So they owe the UK company. So we put it in that order. Then we saw also that the France company owes the UK company 81,663. So the France company owes the UK company. That's very important. That's very important. Then we also saw that the UK company owes the France company 108,824. So owed by, owed to 108,824. Then the France company also owes the UK company, or okay, let's see. The France company owes the South Africa company. France owes the South Africa company an amount of 67 or 63,776. There. Then the last thing there is that the South Africa company owes the France company an amount of 130,591. That's it. We are done. Because the UK company doesn't owe the France company. So this place is going to be dashed. So this is the metrics we're talking about here. But as I mentioned, we'll be doing step 2, 3, and 4. Because if we go back, we are told that we set up the metrics, that is step 2. Transfer converted balances to the metrics, so we've transferred. And then step 4 is total column owed by and owed to. So we will get the totals of the total. So if we go this way, total owed to, you see that we are going to get, we add this to this, that's going to give us 277,519. This plus this, it's going to give us 172,600. And this is only this, so we bring it 130,591. Then we get a totals here of the owed by. Okay. So total owed by. So the UK company in total owes 108,824. The total owed by the South Africa company is 326,477, and then the total France company is 142,439. So 142,439. So this is what we're talking about here. So what are we doing here? What are we doing here? So you realize that in total, the total amount owed to is this. The total amount owed by is also this. So then we come to the fifth step, which is net off the balances. So we're going to net off these balances against these balances. I hope you are following the step. So we're going to be netting off these balances against these balances in relation to how we work out our things. So let's see how we work it out in the netting off. So that'll be step 5, certainly about the netting off. So in step 5, where we net off, look at how the pieces now join together. So in the netting off, you will see that we're going to put the total O2 here, and we're still going to follow the trend in relation to that. So we had UK, South Africa, and then the France. Now if you remember from the previous, realize that the total amount that is owed to the UK company was 277,519. The total amount owed to the South Africa company was 172,877, and the total amount owed to the France company was 130,591. Then we saw also that we're going to put the amounts they owe in relation to that there. So the total amount that is owed to the UK company is 277, meaning that they are going to be receiving this money from both the South Africa company and then the France company. However, you saw from the table that the UK company was owing 108,824. So when we subtract that 108,824 from how much they are owing, right? From how much they are owing, so they are going to be receiving this, and they are supposed to be paying this 108,824. And these people, still in bracket, these people are also going to have 326,477, and this will have 145,439. Now, so I want you to follow the picture here very well. I want you to follow the picture here very well. So you will realize that this is their receivables and this is their payable. So this is how much they are supposed to pay, and this is how much they should be receiving. So if you check, the UK company should receive 277,519, but they will pay 108. So in a nutshell, they are supposed to have a net receipt of 168,600. 695. So this is an additional money that they are supposed to what? Receive at the end of the day. After that, then these people must receive this, but they are supposed to pay this, and you could see that it's very big. So when you check it out, the difference is going to be 153,877. So they are supposed to pay this extra money in relation to the settlement, and this, the France company will also receive 130, but they have to pay 145. So they are also going to be paying 14,848. So the UK company is going to receive this money, so this is owed to, but the SA company will be owed by, they still owe, and then the France company also is still owed. Are you following the picture right here? So this is the total amount they are going to be receiving. This is the total amount they should be paid. If you net it off, the UK company still has to receive 168,695. The South Africa company, because their payment is more than how much they are supposed to receive, then they have to pay an extra of 153,877. Then the France company, the same thing. They are going to pay an extra of 14,848. But the question we ask is, if these people still owe, the South Africa company still owe, the France company still owe, do they owe? They owe the UK company. So that leads us to step 6, where we conclude. So who still owes? You realize that the South Africa company and the France company still owe. Who do they owe? They owe the UK company. So when you add this to this, you should be able to get this answer. This is what we refer to as net off. I believe that you understood the steps that we went through and how we put our metrics together. The first step, the conversion, no big deal. The metrics together, no big deal. And also how we're able to do the net off really here. This is where the real deal is. So at the end of the day, this is where the real deal is. So this is the second step that you need to understand about, this is the second method you need to understand, and that is set off. I think that's the third one, because the first one is invoicing in home country currency. The second one is matching receipt and payment, and then the third one is net off, right? So let's get the last one about the internal methods, and that is going to be leading and lagging. Leading and lagging. Now, this is just a terminology. So leading and lagging. Now, grammatically, when we say you are leading, meaning you are ahead, you move forward. When you say you are lagging, meaning you are behind. So leading means like you take a step forward. Lagging means you delay. So just that grammar is what this technique is about. So lead payment simply refers to where the payment in foreign currency is an advance before goods are supplied. So when a company can adopt the leading technique and pay the money before the goods is received, that is a leading technique. But the lagging technique is where payment is delayed after the goods is delivered. So we even though goods may be supplied, we delay to make the payment in the future, with in mind that the currency will move in our favor in relation to that. So that is what leading and lagging is about. And these are the 4 techniques that are internal hedging techniques. You realize that the company will not engage with any third party, with any forex, with any treasury market, but they are just within the company and decide to do this technique. So this is what you need to understand about the internal hedging techniques. And in the next video, we will look at the external techniques, where we talk about forward contract, money market hedge, currency features, and other methods of hedging. So I'll see you in the next video, and we will discuss about those methods as well.